Your mortgage is tied to war. That sounds absurd. Until bond yields move before your bank changes a single number. In late March 2026, the average 30-year mortgage rate jumped 13 basis points in 1 week. It was the sharpest weekly rise in almost a year. Soon after, it reached its highest level since September 2025. 3 weeks later, rates surged another 34 basis points. No Fed hike caused it. No sudden inflation shock explained it. Mortgage applications dropped 10.5% that week anyway. Then came the hidden wire. Tension abroad was pushing U.S. Treasury yields higher, and mortgages were dragged behind them. The price of a home loan was being pulled by foreign bond markets, oil routes, and governments most borrowers never think about. That is the trap. Most people think their interest rate begins and ends with the central bank. That belief is comforting. It is also incomplete. The cost of debt is shaped by who buys government bonds, who sells them, and who panics first. The U.S. Treasury market is the base layer beneath mortgages, car loans, credit cards, business loans, and retirement portfolios. When long-term Treasury yields rise, lenders demand more for 30-year home loans. Banks add their own margin on top. That is where household pain begins. Behind the screen sits a small club of foreign governments, central banks, sovereign funds, and global investors holding enormous piles of U.S. debt. If one major holder needs dollars quickly, the fastest option is brutal. Sell treasuries. When enough bonds hit the market, prices fall, yields rise, and ordinary borrowers pay the difference through higher monthly payments. The Federal Reserve Bank of Kansas City estimated that about $141 billion in foreign treasury selling over 1 month could lift U.S. yields by roughly 57 basis points. Other estimates run from 25 to 100 basis points. A Journal of International Economic Study found that a $100 billion sale could push yields up around 100 basis points within a month. That sounds technical until it lands on a family budget. On a median new home, a 50 basis point rise adds about $130 each month to the mortgage. A 100 basis point rise pushes the extra cost above $260 each month. Over 30 years, that becomes tens of thousands of dollars. One bond sale can tax a future. Housing is not just shelter. For many middle-class families, home equity is the largest wealth pool they will ever build. When rates rise, buyers disappear, prices stall, and owners pay more to carry the same asset. That is silent damage. Construction slows because projects no longer pencil out. Renovations get delayed. Framers, electricians, roofers, plumbers, and contractors lose work before headlines admit trouble. Then the weakness moves outward. Car loans become more expensive. Student loans become harder to refinance. Small business credit lines tighten in towns far from any trading floor. A distant liquidity shock becomes a local hiring freeze. But rarely explained. Mortgage pain is not always born inside a borrower's country. Sometimes it begins when a foreign holder decides cash matters more than bonds, and that decision has a backdoor. The Federal Reserve runs something called the FIMA repo facility. FIMA means Foreign and International Monetary Authorities. It lets foreign central banks bring U.S. treasuries to the Fed, post them as collateral, and receive dollars for a short period. It is a pawn shop for nations. The facility began on March 31st, 2020, during the COVID crisis. It was described as temporary and intended to last for at least 6 months. Then it was extended. Then extended again. On July 28, 2021, it became permanent. No public referendum changed it. No household borrower voted on it. A crisis tool became part of the plumbing. The price was set high on purpose. It stood 25 basis points above the interest rate on excess reserves. In calm markets, private funding should be cheaper than the Fed window, so healthy players avoid it. A foreign central bank only uses this facility when selling treasuries would be worse than paying the Fed's markup. That is the point. The facility exists to prevent forced selling from hitting the open market. Domestic borrowers can be squeezed by higher rates, while foreign official holders know a dollar backstop exists. One side faces tightening, the other side gets emergency plumbing. Critics call this a death loop. If major players believe a safety net will appear when markets shake, prices stop telling the full truth. Markets depend on price discovery. Without it, nobody knows what risk really costs. This did not start in 2026. On September 17, 2019, the overnight repo market cracked. The repo rate, which banks pay to borrow cash against safe government bonds, jumped from about 2.4% to more than 5% in one day. At one point, it briefly touched double digits. That market barely moves. The trigger looked boring. Corporate tax payments drained cash from the system, while a large Treasury settlement pulled even more liquidity away. Around $120 billion in available reserves vanished in one day. The institutions that normally smooth these gaps did not step in fast enough. Not because they were collapsing. Post-2008 rules and incentives made them more cautious with balance sheet space. Then the New York Fed acted within hours. It injected $75 billion and repeated the operation through the week. The lesson was ugly. Predictable events had nearly broken a critical funding market. Nobody knew the safe buffer. 2 years later, in July 2021, the Fed made emergency repo support permanent for domestic banks through the Standing Repo Facility. On the same day, it made the FEMA facility permanent for foreign official holders. One backstop was domestic. One was global. Both were built to stop liquidity stress from exploding again. Then another pillar shifted. For years, Japanese institutions were among the steadiest buyers of U.S. government debt. Their buying was powered by the carry trade. Investors borrowed yen at extremely low rates, converted the money into dollars, and bought higher-yielding U.S. assets. The spread was the profit. That trade worked because Japanese rates stayed near zero for years. Money crossed the Pacific so reliably that markets treated it like furniture. It looked permanent because it had lasted so long. Then 2025 changed the math. The Bank of Japan moved away from its long era of ultra-loose policy. It raised rates in stages. By December 2025, the policy rate reached 0.75%, the highest level in 3 decades. The number looked small. The effect was large. A carry trade works best when borrowed money is almost free. Once yen funding becomes more expensive, the profit gap shrinks. At the same time, Japanese bond yields rose above 2%, giving domestic investors a safer reason to bring money home. That matters because U.S. debt issuance was hitting records. The borrower needed more buyers just as a reliable buyer became less eager. Stress had to move somewhere. Inside the U.S., another debt wall was forming. Commercial real estate loans rarely behave like normal household mortgages. Many do not slowly amortize to zero. They come due and must be refinanced. Nearly $1 trillion in property loans were scheduled to mature in 2025. Hundreds of billions more followed in 2026. Together, more than $1.5 trillion needed new terms in a higher rate world. A building financed at 3% now faces a much costlier loan. Worse, the building may be worth less than before. If rents cannot cover the new payment, the math breaks. Hope becomes accounting. Banks call the workaround, extend and pretend. They push deadlines out 1 or 2 years, avoid recognizing the loss, and hope rates or property values improve. The pressure is uneven but severe. In that single year, 35% of hotel mortgages and 24% of office mortgages came due. Offices face a deeper wound because remote work reduced demand. Many buildings never refilled after the COVID pandemic. Hotels face their own pressure. Revenue swings with travel, conferences, and corporate budgets. When those weaken, refinancing becomes harder. Regional and community banks often hold heavy commercial property exposure. Those same banks fund local businesses, first-time home buyers, and payroll lines. When property loans look shaky, banks protect themselves by lending less. Now the squeeze has 2 jaws. Foreign demand is less dependable. Domestic credit is tightening. Losses remain hidden because loans are being modified, extended, or kept current on paper. The losses do not disappear. The Gulf region runs on dollars because oil is priced in dollars. Export revenue arrives in dollars, and sovereign wealth funds measure power in dollars. When the Iran war began in late February 2026, the shock traveled through energy markets. The closure of the Strait of Hormuz choked roughly 1/5 of global oil flow. Oil prices rose. Inflation expectations followed. Treasury yields and mortgage rates moved with them. Even oil-rich states need dollars. If dollar funding tightens, foreign institutions face a painful choice. They can sell treasuries into a stressed market, pushing yields higher and hurting the value of bonds they still own. Or they can borrow dollars against collateral through official backstops. The second option prevents panic selling, but it also proves the system depends on constant reassurance. Kuwait's U.S. Treasury holdings climbed near a record $66 billion. UAE holdings sat in the tens of billions and were growing, supported by much larger reserves. These are not weak creditors begging for rescue. The goal is market stability. The danger is not just that a creditor loses money. The danger is that a major holder becomes a forced seller when buyers are already nervous. That is how liquidity becomes a mortgage payment. And the holder base changed. In 2024, foreign private investors overtook foreign governments as the largest overseas holders of U.S. Treasuries. Private capital behaves differently from central banks. Asset managers, hedge funds, and leveraged traders move quickly when spreads, rates, or funding conditions change. The shock absorber became reactive. So what happens when the world's safest market depends on buyers who can vanish, backstops that cannot be questioned, and borrowers who feel the pain last? Since 2008, the Fed's total commitment to rescuing the financial system has topped $29 trillion. That money did not build roads, schools, or factories. It bought time for a system that keeps needing more time. This is not a prediction of instant collapse. It is a map of dependency. Debt costs now depend on treasury buyers, foreign liquidity needs, oil shocks, refinancing walls, and central bank backstops. The chain is long, but the bill is local. For households, the lesson is personal. High-interest debt can become a trap. Emergency savings are not optional when credit tightens. Refinancing windows can close faster than people expect. The most dangerous debt is the one that assumes tomorrow will look like yesterday. By the time the payment notice arrives, the bond market has already spoken. The war may be distant, the seller may be foreign, and the panic may be invisible.